Well, hello everyone, and welcome to our first time home savings account webinar. For those of you who don't know me, my name is Jacqueline Ozdemir, and I am a financial advisor with Asante Capital Management, Ferguson Financial Planning. For those of you, I may be working with you. For those of you who are just seeing me for the first time, I do work a lot with working professionals and executives, really to help them make smart decisions with their money and make sense of all their different investments. So, as during our working career, we may accumulate assets personally through our investments, maybe some real estate, and also through employer packages that we have or savings programs. And so I help them understand how all those assets are working together to reach a common goal. And at the end of it, understanding how the numbers that they see on paper are actually going to fund their future retirement. Now, today's session is going to be a little bit different. We're not necessarily going to be talking about retirement, but we are going to be talking about saving for a first-time home. And so throughout the presentation, I'm going to be walking through, what is the FHSA account? Now, I will be referring to this account as a first-time home savers account or an FHSA. Obviously, they're both the same thing, right? I'm just using the acronym. So we're going to talk about who this account might be good for or who's eligible for this type of account. We're going to talk about how much you can put into this type of account and some strategies for getting the money out. And we're going to talk about how long the account can be open for. Now, this is great. I'm going to talk about sort of all the rules as it comes to this account. But at the end of the day, we're really most interested in is how does it apply to you and how can you use this account for your advantage? And so that's why we're going to go over a lot of different case studies so that perhaps you can sort of put yourself into one of those scenarios to say, well, this is how this type of account could work for me and how I can benefit from it. Now, we obviously have limited time here today. There's lots to discuss. So if there's something that we don't get into or that you have additional questions about, we do have at the top of the screen, or depending on what device you're on, there is going to be a section where you can ask questions. And then, of course, you will have my contact information if you want to reach out afterwards to ask additional questions. Okay, let's get started. So really important question is, well, who can open up an FHSA account, right? Like who's allowed to do this? You have to be a Canadian resident. So if you're not living in Canada right now, probably should not be opening this type of account. And you have to be considered a first-time home buyer. Now, the definition of a first-time home buyer might actually be different than what you might think it is. So you are considered a first-time home buyer if in the last 4 years, you did not occupy a home that you owned or one that your current spouse or common law partner owned. Now, the word, I think, occupy is really important here because I've said you have had to not have lived in a house that you own. So it is possible to own a house, but not necessarily occupy it as a principal residence. And you're going to see through our case studies why that's important later. This type of account, it was recently announced that it's available by CRA back in April. Different institutions have been rolling it out since then. But what's important to know is that it is a registered account. Now, a registered accounts are nothing new. We already have those already exist. Common examples are registered retirement savings plan or an RRSP and a tax-free savings account or TFSA. Registered means that money in it, you're not going to incur taxes if you invest within these accounts, or there might be some sort of tax benefit to having these types of accounts. And what I love about the FHSA is that it's actually a combination of some of the best parts of an RRSP and a tax-free savings account. So similar to an RRSP, if you put money into this type of account, you're going to get a tax deduction. So what is a tax deduction? Well, just say I make $100,000 a year and I put $8,000 into an RRSP or an FHSA, I'm going to knock $8,000 off my income as far as CRA sees. So CRA will see Jacqueline didn't make $100,000. It looks like she made $92,000 and I will be taxed accordingly, which is going to be a little bit beneficial. I'll probably wind up getting a refund on my taxes or a reduction in taxes owing. So you put money in, you get a nice little tax deduction. Again, another thing that not everyone realizes when it comes to RRSPs and FHSAs for that matter is that you can put money into these accounts. You don't have to claim the deduction right away. So if I'm someone that's currently making maybe $50,000 or $60,000 a year, I'm not going to get a big bang for my buck when I deduct that from my income. I might be better off putting the money into these accounts, having a tax deduction, but not actually claiming it on my tax return, and rather saving it for a later year when perhaps I'm making more money, like $80,000 or $90,000, I'm going to see a bigger benefit on my tax return if I choose to have my deduction claimed at a later date. But anyways, that's a little bit outside of the scope of this presentation, but just something to know. So like a TFSA or an RRSP or other types of accounts, you can put money into an FHSA and you can invest it. You can invest it in stocks, bonds, mutual funds, ETFs, GICs are providing over 5% right now. So there's a bunch of different things that you can invest in within the account. When you invest in the account, any growth, dividends, interest, income, none of it's taxed. It's totally sheltered. And so far in that regard, the FHSA is pretty similar to an RRSP. One of the big differences, though, of course, is that you can actually take money out of the FHSA and not pay tax. So we know if we put money into an RSP, most of the time we take money out, we're going to be paying tax on it. You put it into an FHSA, you take it out for the purpose of buying a first-time home, and you're not going to pay any tax. And so in that regard, it's a little bit similar to a TFSA. If you were to take money out, let's say, after having opened this account, and you take money out to, let's say, buy a car, that money is going to be taxed. And it's going to be taxed as income, which is the most punitive way that you can be taxed. Okay, so I would not recommend opening up this account to get the tax deduction and then later use it to buy something other than a home. Or there's some other options that we'll see later on. But again, you put money in, you get a nice tax deduction. You take money out for the purpose of buying a home, you're not going to pay any taxes on that. So there is a lot of benefits from a tax perspective from having this type of account. So, well, let's just put all our money into it because this sounds like a really great deal. Of course, there is going to be limits similar to an RSP or TFSA. There's going to be a limit to how much you can actually put into this type of account. And the rule here is that from the time you open it up, you can contribute $8,000 a year. You're going to be able to carry forward some of this room, but there's a lifetime maximum of $40,000. So I'm just going to walk through a few scenarios. So let's say I open up an FHSA account today. I could put in $8,000 for the 2023 calendar year. Alternatively, let's say I open up an FHSA account today and I put in $1,000. So 2024 rolls around, I have $8,000 of room available from 2024, and I have $7,000 of room left over from 2023 that I didn't use. So theoretically, I could dump $15,000 into the FHSA account in 2024. Now, taking that one step further, let's assume again, I open up the account today and I put in $1,000. Okay, so now I have $7,000 of room that I didn't use. So now it's 2024. I have another $8,000 of room, but I'm not necessarily going to use it. I don't have any money to put in the account. So now it's 2025. Well, I have $8,000 of room from 2025. I have $8,000 of room from 2024. So that's $16,000. Okay, now I have $7,000 of room from 2023. Okay, I can put in $23,000 into the account. And that's the difference between other types of accounts. I can't do that. The max I can ever put into the account in 1 year is going to be $16,000. If I had to guess, maybe CRA did it this way to prevent people from just making a one-time payment of $40,000, reap the benefits of the tax deduction, and then pull it out 5 months later to buy a home. I mean, I can kind of argue why maybe that's why they've set it up this way, but either way, max amount you could ever put in any 1 year is going to be $16,000, assuming you have some past contribution room. One thing I find interesting about this account and how it differs from a TFSA is with a TFSA, my contribution room is accumulating whether or not I have an account or not. So if I'm, in my 30s and I've never opened up a TFSA before, I would have $88,000 of room. Okay, because that's all the past accumulation room since the account has been available. The FHSA is different because I had to have at least opened the account to start accumulating the room. So if you're unsure whether you should open one, but you're pretty sure you want to open it, but you don't have $8,000 available, you could still open it up, throw in $500, and at least now you've started the clock on your contribution room. Okay, so just one strategy maybe to consider depending on your situation. And again, like many other types of accounts, you could hold multiple FHSA accounts. It doesn't mean you get more room. You could have an account at Asante, at a bank, at another brokerage. The end of the day, though, that $40,000 lifetime limit that's your limit. It's really based on your SIN number, not the number of accounts you have open. So just because you've opened up 3 FHSA accounts at different institutions doesn't mean you get $120,000. You still get $40,000. Generally, I'm going to recommend not doing that and probably just opening a 1 account. It's going to save you a lot of trouble when you come to, need to take the money out in the future. You're not scrambling around to 3 different institutions. As well, it's going to be a lot easier to track your contribution room if you just keep it at one place. Okay. So now let's fast forward and say, well, we've opened up the account and maybe it's 5, 10 years later, I'm ready to buy my home. So I've been saving, I've invested in the account, I have some money, I want to take it out. So like I talked about before, if you're taking the money out to buy a first-time home, you can take it out tax-free. So you're not going to pay any taxes. You're going to take the money out of the account and you're going to put it towards that home and you're done. If time goes by, and that time is 15 years, so you've opened up the account and now we're 15 years later, you've saved in the account, you've had some good growth in the account, and you've just decided your home ownership is not for you. Okay. So you said, I'm probably not going to own a home, or at least I haven't bought in one within a 15-year time period. You can roll this account over to your RRSP or open up an RSP and roll the money over on a totally tax deferred basis. So 15 years is the amount of time the account can stay opened. During that time, you will have either bought a house or not. And if you haven't, you can roll the money into your RRSP. So worst case that's happened here is that you've put money into the account, you did not buy a home. It's not like the money is going to disappear on you from the account. You can roll it into your RSP, and now you've simply boosted your retirement savings. Okay. Now, just something to keep in mind with that, at some point in the future, you will, of course, be taking money out of your RSP, and at that point, it will be taxable. But you've simply redirected the funds that were originally meant to purchase a home. You've now just redirected them towards your retirement savings. I have a chart up here on the screen. It's a little bit busy, but it does highlight some of the key features of the FHSA and how it compares to a TFSA and an RRSP. So FHSA and TFSA, everyone sort of gets the same amount of contribution room provided they're eligible for the account, whereas the RRSP, as we know, the amount of contribution room you have is really dictated by what your income is. So another thing I want to point out about the RRSP, because I might be going through this and you're thinking, well, doesn't this type of account already exist? Why is Jacqueline saying that it's a new type of account? There already is a home buyer's account that you can open. So if you're thinking that, you might be thinking about the home buyer's plan that's available through your RRSP account. So prior to the FHSA, and even still, the CRA will allow you to take out $35,000 from your RRSP for the purpose of buying a home. This is one of the only exceptions. There's another one, and I won't get into it in this presentation. But in this instance, you are allowed to take money out of your RRSP and put it towards a first-time home purchase. So this is referred to as the home buyer's plan, and it's through your RRSP. Normally, if you take money out of your RRSP, it is taxable. But the home buyer's plan allows you to withdraw $35,000 from this account. Now, of course, you have to have $35,000 in the account. So you can't have 30 and take out 35, but you can have 35, 50, 100. Take out 35,000, put it towards your home. The difference between the FHSA and the home buyer's plan, though, is that with the home buyer's plan, you have to pay the money back to your RSP over a 15-year time period. So I really like the FHSA because you don't have this obligation to pay it back. You think about it, you're a first-time home buyer, you've probably stretched yourself on the mortgage, or you've bought a house and now you have these mortgage payments. It's a lot. And now you also have to pay back your RSP. Like, that's a really heavy strain on your cash flow. And so the FHSA, by going this route, you don't have the worry of having to pay back your RSP at a time when your expenses are probably going to be pretty high for a little bit. So the two programs can be used together, but I think if someone at this point is debating between the two, the FHSA might provide a little bit more flexibility in the sense that you can take out more in the future to put towards a home, and you don't have the obligation to pay the money back. And worst case, you don't buy the home, the account stays open for 15 years, and then you just roll it into an RRSP anyways. So for anyone on this call that's maybe debating between the two, of course, everyone's situation is going to be different, and this might be good for a one-on-one conversation, but just very generally speaking, I'm leaning towards the FHSA account for people that are undecided between an RSP and an FHSA, but their end goal is to purchase a home. So we've talked a lot about this type of account and the rules around the account, how you can withdraw money, who it might be good for, who's eligible to open it. But I think we're going to get the most value from looking at various case studies and just understanding how, in practice, these accounts can actually be used and how they can benefit people. So the first case study we're going to look at is pretty straightforward. This is an individual, we'll call her Jenny. She's 24, she's working, and she really has the goal of owning a home. She's currently renting, or maybe she's living at home, but she really wants to own a home. And so she opens up a first-time home savers account, and she contributes the maximum amount every year. So she contributes $8,000 per year for the next 5 years. And her $40,000 over that time, she's invested, in a medium risk fund, and she winds up with $52,000. So the value of her account grows from $40,000 to $52,000. I said earlier that the max amount you can put into the FHSA is $40,000. That is true. It doesn't matter what it grows to. So if you put money into the FHSA and it grows, maybe it grows from 40 to 50 to 60 to 70, whatever, that doesn't matter. That's not considered your contribution room. That's growth that has occurred within the account. That has nothing to do with the $40,000. So in her case, her $40,000 has grown to $52,000. After this time period, so now it's been 5 years, she has $52,000. She's going to take $52,000 out of this account. She's going to put it towards her first-time home purchase, and she's done. She doesn't need to pay the money back to her FHSA. She doesn't need to pay any taxes. So she's had the benefit of saving in a tax-deferred account. She has $40,000 worth of tax deductions, which she may or may not have claimed yet on her tax return. And she's now, owning a home. So she's been able to save more for her home through this account. Another example, fairly similar to the first, but a little different. Michael, again, young guy, wants to own a home. He goes and opens an FHSA. But Michael doesn't necessarily have the cash flow to contribute to this account every year. However, Michael does have a very generous grandmother who is gifting him $8,000 a year to contribute to his FHSA. So Michael's grandmother maybe has, a steady stream of income. Perhaps she has her old age security, CPP, her own RSP withdrawals, maybe a pension plan from work. She wants to sort of spread her wealth and give it to her grandchildren. And so the money is coming into her bank account from these various sources, and then she is gifting it to Michael, and Michael is ultimately putting it into his FHSA account. Okay, so these are after-tax dollars from his grandmother that are going into his FHSA account. The account, like we talked about before, he's putting in $8,000 a year, so he winds up maxing out at $40,000. It grows, he keeps it open a couple of years longer, and then ultimately takes the money out, so the $40,000 plus any growth, and he's going to put that towards his first-time home purchase. Again, he's not going to have to pay this money back. He's been able to claim the tax deductions, and any growth that occurred in the account was totally tax-free. So this has just put him in a better position to be able to afford that first-time home. I talked earlier about how the RRSP home buyers plan exists and how it might work with the FHSA to help with housing affordability. So Christopher's 33. So when he was in his 20s, the FHSA account did not exist. So he was saving in an RSP. So, he started working at age 25. He's been working for 8 years. He put money into an RRSP account every year. Again, he got his tax deduction, and he's ultimately been able to save up about $50,000 in this account. However, it's 2023, and now he's able to open up an FHSA, and he still has not bought a home. So he opens up the account, and like the other examples, he's putting in $8,000 a year to his account. So he does that for 5 years. So now he has $50,000 in his RSP, and he has some money in his FHSA account. he finds a home that he loves, and in his early 40s, he decides to buy the home. So he is able to take out $35,000 from his RRSP, totally tax-free, and he's able to take out all the money from his FHSA, also totally tax-free. Now, for simple math, let's assume that Christopher didn't actually invest the money in his FHSA, and it's just remained at $40,000. So we have $35,000 from the RRSP, and we have $40,000 from the FHSA. So Christopher is able to put down $75,000 towards his first-time home purchase, and all of that is coming out of his accounts entirely tax-free. Now, $35,000, which came out of his RSP, will need to be paid back to his RSP over the next 15 years. Okay, so that's just the only thing to remember, but he still benefited. He was able to make a larger down payment, which might have provided him a little bit of relief on his mortgage payments anyways. Another example, which I think is a little bit unique, and some people here might find interesting, is our case study on Laura. So Laura owns a lot of different real estate properties. So she is a landlord. She owns 3 rental properties, and she rents these places out to others. She doesn't live in any of these properties, and she hasn't lived in any of them for the last 4 years. She doesn't because she's making good money from her rental properties, and she simply rents her own another apartment elsewhere. So she lives in an apartment that she rents, and then she has these other properties that she rents out to other people. So in other words, based on the definition, she does not occupy a home that she owns as her primary residence. So in that regard, she is eligible to open up an FHSA account. So she opens up the account, she can save in it accordingly, and then she can either use it in the future, like the other examples for the down payment on a home, or she can transfer the funds to her RSP in 15 years. So I think this is a really unique situation where we would find this, but it's also important to know that it really, being eligible for the FHSA has a lot to do with what you claim as your primary residence. And in this case, despite owning properties, none of them are her primary residence. And our final case study for today is going to be about Megan and Steve. So Megan and Steve are dating. Megan owns a home. Steve does not. They do plan to get married, but they don't yet live together. Steve is able to open up an FHSA account before getting married. And he does this, again, before getting married, because based on the definition, he does not occupy a home that his spouse or common law partner currently owns, right? So he fits the definition of a first-time home buyer. So Steve will get to enjoy the tax deductibility of the FHSA account. So he gets the benefits of having a tax deduction and not having to pay taxes on any growth within the account. And then, after moving in, he can still later use this to put towards a first-time home, or he can roll this into his RSP. And again, rolling it into your RSP isn't going to have any effect on your RSP contribution. So I think in these case studies, we were able to cover a lot of different situations, but I recognize that every situation is so different. And so it's possible that we might not have looked at all the cases today. Okay, but this, I think, gives us a really good overview. And of course, like I said before, if anyone has additional questions or wants to know how, see a case study on themselves, we can certainly put that together for you. There you have it. Everything you need to know about FHSA accounts. Thank you everyone for participating. I'll leave my contact information up here that you can see if you want to be in touch. Have a great rest of your day.